Hello and welcome to Three Questions with. Got my buddy Paul Falewicz with us. Paul is a fractional CFO. Good morning, Paul. Welcome to the show.
Thanks for having me on again, Kevin.
So, Paul, we're coming to the end of the first quarter. It's time to check our numbers. Why don't people even do this? We just pretend it went well. We should really take time, all kidding aside, to look at them, right?
Yeah, I mean, I think people are really scared of looking at their numbers. Working with business owners the past 6 years, numbers are something that kind of scares them because they don't understand it. And most things that you don't understand, you kind of put under the covers and you wait until a sunny day and you want to look at it at that point. So, people just don't want to look at them because they feel like there's bad information, there's bad news, but there is good information sometimes in there that shows how your company's running, what's going on. And I tell people to look at it monthly. The worst case scenario, you should definitely look at it at least quarterly to understand what's going on, because let's just say there's a problem. You're draining cash somewhere, you're overspending on something, you don't realize that a supplier raised the price somewhere along the lines, and then you're not making as much money or you're losing money. If you don't see it for 6 to 9 months, there's a lot of money that goes out the window at that point. You want to be able to look at it quicker to make those decisions a lot faster so that your business doesn't struggle and you're able to see what's really going on within the business.
So, Paul, which statements should I focus on then?
There's really 3 of them that you should focus on. 2 of them that are pretty easy for everyone to follow, which is an income statement, which just shows your profit and loss. It shows all of your revenue coming in. It shows all of your expenses. The bottom line is what your profit is. And then a balance sheet, which shows your cash, shows any receivables that people owe money for to you, and then also what you owe to other people. And then the third one, which is a little bit more complicated, and I kind of avoid with people because it's tougher to understand, as a cash flow statement. But you understand the cash flow side of it, you'll see what's coming in and what's going out. But there's a lot of other transactions that get into the boring accounting side of the world that a lot of people don't want to follow. So kind of stay away from that. But again, the cash flow simply is you just want more money coming in than going out. You have positive cash flow, you're good. There's a lot of other transactions that go in there. If people are investing in your business or you're buying assets, a lot of other complicated accounting stuff, but the simplicity side of it is just more money coming in than going out.
So, Paul, one of the things you mentioned is receivables, because we have friends who look at, hey, I had great sales, Paul, but if I don't collect the money, not really a sale in my eyes, at least.
Yeah, I mean, I look at that same way. You could do, you could do 10 hours of work, bill out for your services, sell your product, and then if the client never pays you, it's as if it never happened. When it's money that's out the door, you've expended something. If it's a service related, you've expended your time. If it's a product related, you've purchased something to put this all together. And if you never get paid from your client, it's as if the sale never happened, because at some point in time, you're going to have to get that receivable off your books, which just negates all of that revenue that you had put on in the beginning. So, most people struggle with that because they think the sale's done. They send the invoice out and everything's going to be great. Invoice might not have received, it gets lost in the mail, it gets lost in an email, it gets stuck in spam. There's a 1,000 reasons why invoices don't get to the final client. But if you don't follow up on it, most people will pay you. Some people will kind of, forget about it and use that, time in order to not pay you on time. But most people are usually pretty good about it. But you just have to follow up once or twice, and hopefully they'll pay you and you'll be in good shape.
So, Paul, we've looked at the statements. We can see they're going in the wrong direction, but we don't know why. Can you work with people to explain to them trends and, hey, this is why things are happening, to help them get back on track? Or maybe they need to cut the budget. They don't know how to do that. Can you guide them through that?
Yeah, I mean, I do this with all the clients. We're having simple conversations. We're not trying to make it too complex. It's as simple, again, as I said, with the cash flow, money coming in versus money going out. Revenue, you want to be able to know what your prices are so that you price your product correctly, you price your service correctly, so that on the bottom line, you're making money. And you can kind of see the trends when you look year over year, or even month over month. You'll see that you're either spending more in a certain area, you're spending less, and revenue is going up. And you can kind of, take the good with the bad when you're looking at those financial statements to understand really what's going on with the company. And then you kind of see what's going on in industry, you see what's going on in the economy here. And there's a lot of different factors of why things are either moving in the right direction or the wrong direction. But by just looking at them and having a conversation with it, it starts to at least get the business owner to start think about what's going on and make sure that that stuff is going to be done correctly going forward.
Paul, last question. Can you help people when it's time to raise their rates? We're all a little hesitant in this. Like, well, Paul, if I raise my rates, I'm going to lose all sorts of customers. But in some cases, sounds mean, but that may be an okay thing because you're not making any money from that person. Yeah.
This is what I tell all the clients, and I just had this conversation the other day with somebody. Everyone else is not afraid to raise their rates. You're afraid to raise your rate. So the minute you do it, someone cuts you the check, you get paid, and everything is great. It becomes kind of like a little bit of, it feels good in your veins, and you want to do it for everybody. You got to be careful by not overextending yourself and raising prices 50%. But everyone, just look at everything in the world that we buy. Everything goes up 3 to 5% every year. If you do that, you're kind of following with what's going on with inflation, with the economy, and everything like that. And everything costs more, as it did when bottles of milk used to be 50 cents. Now they're $3 a gallon. I mean, everything kind of goes up over time. So raising your rate slightly will make you feel better, and you'll notice it in your bottom line as long as your costs can stay the same.
So, Paul, what's the best way for people to reach out to you if they need help with all of these issues?
Easiest way is to check out my website, Succentrix.com/Paul Falewicz, or send me an email at paul.falewicz@Succentrix.com.
Well, I appreciate you taking a few minutes to come on the show. And as always, thanks for being my friend.
Thanks, Kevin.